Hello, finance aficionados. Eager to fine-tune your trading playbook and master the evolving economic scene? If you've passed over golden chances or been caught unaware by swift alterations, keep tuned. This September 2nd, 2025 overview is brimming with practical strategies to revolutionize your investments. Welcome to AmosFinance, the place where we decode finance for every level, from starters to market pros. I'm John Hawk, your trusted advisor, and today we're examining the newest in equities, digital assets, worldwide developments, and further. Remain until the close for my vital insight that might safeguard your funds or uncover a major breakthrough. If it strikes a chord, hit like right away, join subscribers for constant updates, share your Prime Money query in comments, and enable bells. Let's broaden this network. We'll explore gauges, leading stocks, debt securities, forex, resources, income projections, tokenized currencies, international happenings, policy adjustments, cost increases, directions, and that pivotal recap. How could this shape your finances? Time to dive and transform data into wise choices. Let's begin with the market's compass, the major indices. The S&P 500 finished at 6438.50, down 0.34%, reflecting tariff jitters weighing on broad portfolios. The Nasdaq shed 0.28% to 21395.20, as tech names faltered, while the Dow slipped 0.15% to 45,476.20. Overseas, the FTSE 100 gave up 0.25% to 9164.50, while Japan's Nikkei slid 0.30% to 42,590.00 under Bank of Japan adjustments. Year over year, these benchmarks still shine, up 12–16%. But think of it this way, a $25K Nasdaq ETF is up $3,400 this year, yet you still lost $70 yesterday. A reminder of how fragile sentiment can be. Takeaway, short-term dips can slice 1–4% off global portfolios if left unhedged. Savvy investors lean into US-centric ETFs like VOO, using weakness as entry points. Do you see this pullback as a red flag or a buying window? Now to the market movers, the top stocks shaping headlines. Apple eased 0.10% to 231.80, steady on product strength but vulnerable to tariff-driven supply costs. Tesla fell 0.50% to 332.20. Its EV momentum is solid, but border hurdles may trim deliveries. Microsoft slipped 0.20% to 505.70, continuing to act as a defensive tech anchor. Amazon dropped 0.80% to 227.00, while Meta lost 0.90% to 732.00, even as ad revenue expands. Over the past year, these giants surged 18.55%, but volatility cuts fast. Tesla's 0.5% dip erased an entire week's gains. Imagine holding $10K in Tesla stock, you're down $50 overnight. But with EV adoption climbing, many see these drops as discounts, not danger. Takeaway: expect 8–18% swings around earnings and policy news. Cushion your exposure by mixing in value plays alongside growth. Which of these five would you ride through the next quarter? Shifting to bonds, your ballast in turbulent markets. The US 10-year yield ticked up to 4.240%, while the 30-year sits at 4.895%. Germany's 10-year prints 2.735%, the UK's at 4.730%, and Japan lingers near 1.610%. Compared to last year, US yields climbed about 0.45 points, signaling firmer borrowing conditions. For perspective, a family with $50K in treasuries earned an extra $225 in income this year versus 2024. That's the power of rate shifts. Takeaway: higher yields reward income seekers, but stress borrowers. Mid-duration bonds can shield 5–10% of your portfolio from equity turbulence. Do you treat bonds as a safety net or an afterthought? Currencies act as silent referees in global trade. The euro gained 0.15% to 1.1705 despite the ECB's cautious tone. The pound edged up 0.05% to 1.3510, showing surprising resilience. Meanwhile, the yen softened, with USD JPY rising to 147.00, plus 0.05%. And USD CNY climbed to 7.1520, plus 0.08%, under tariff weight. The Naira held steady at 1534. Big picture. The dollar has strengthened 5–10% against peers this year. That's a win for US importers but a squeeze for exporters. Takeaway: a strong dollar can erode overseas revenue but boost domestic spending power. For those with global exposure, hedging forex risks isn't optional, it's survival. Commodities often play defense in times of uncertainty. Gold jumped 1% to 3550.00, silver surged 1.8% to 41.50, as investors sought safe havens. Oil went the other way. WTI slipped 0.8% to 63.50, and Brent 0.7% to 67.30, pressured by demand concerns. Natural gas surged 3% to 2.95. Over the past year, oil tumbled 17–18%. For a $15K energy ETF, that's a $2.55 loss, but shippers saved up to 5% on fuel costs, boosting profits. Takeaway: commodities hedge inflation and add balance. Allocating just 5–10% to gold or silver can offset sharp equity drops. How much of your portfolio is in hard assets? Earnings season, where surprises can move stocks 5–15% overnight. This week, Zscaler, 43.14b, posted EPS of 0.47, showcasing cybersecurity resilience. Nvidia, 4.45t, beat with 1.01, a reminder why it dominates AI chips. Royal Bank of Canada, 193.88b, earned 3.29, signaling stability in finance. CrowdStrike, 102.86b, impressed at 0.83, while Snowflake, 64.15b, delivered 0.27 in the cloud sector. Think about it, a single Nvidia beat can lift semiconductor ETFs by 3–5% in one session. Takeaway: track earnings calls closely. Guidance on tariffs and costs often matters more than EPS beats. Which company's results surprised you most? Crypto remains a roller coaster. Bitcoin dropped 0.69% to $107,563, still up triple digits this year. Ethereum slipped 1.04% to $4,389.42. Solana fell 2.16% to $198.56, and XRP tumbled 3.32% to $2.72. Binance Coin dipped 1.05% to $869.87. Put differently, a $10K Bitcoin position is still worth $25K plus this year, even after losing $70 overnight. Takeaway: crypto dips create opportunities, but risk is real. A 1–5% portfolio allocation can capture upside while capping downside. Would you add on this pullback or wait it out? Global tensions are back in focus. The EU-US trade pact stirred tariff disputes with India. Taiwan boosted defense, Ukraine launched new missile strikes, and US-Russia relations worsened. These flashpoints can ripple through commodities and shipping, raising costs 5–10% overnight. Takeaway: geopolitical shocks are unpredictable, but diversification cushions the blow. Keeping exposure balanced between local and global markets is your best defense. Central banks remain the market's steering wheel. The Fed holds at 4.50%. The ECB at 2.15%, and the BOE at 4.00. Rate cuts are on the table, especially with job data softening. The math is simple. A 0.25% rate cut can lower mortgage payments by $100 plus per month on a $400K loan. Takeaway: falling rates mean cheaper borrowing and potential equity rallies. Positioning early in rate-sensitive sectors like housing and tech could be a winning move. Inflation tells a mixed story. The US held at 2.7%, steady, but under tariff threat. The UK ticked up to 3.8%, driven by services. China flatlined at 0%, raising deflation concerns. Takeaway: uneven inflation pressures shape policy moves. Protect your cash flow with inflation-linked bonds or dividend stocks. Today's trend snapshot: equities drift lower, bonds hold firm, the dollar stays strong, and commodities split, gold up, oil down. Crypto cools, but remains resilient. Takeaway: the theme is caution, but also opportunity. Focus on resilient sectors, AI, healthcare, and energy efficiency, for steady growth. Here's the bottom line: tariffs and Fed policy keep markets tense, but strategy makes all the difference. Anchor your portfolio with US giants. Use bonds and gold for balance, and keep a measured crypto slice for upside. Enjoyed this update? Hit like, subscribe for daily insights, and drop your $10K investment strategy in the comments. Would you put it into gold, bonds, or crypto today? Let's compare notes. See you tomorrow. Trade smart, grow strong. #AmosFinance #.